What if I told you that right now, in 2025, thousands of traders are using the exact same strategy that generated $175 million in profits, and 95% of them are losing money? This isn't some hidden secret or expensive course. The rules are public, free, published in books, websites, even Wikipedia. Hell, Richard Dennis himself said, I could publish my trading rules in the Wall Street Journal and no one would follow them. And he was right. Just last August, a trader using the original Turtle rules captured a 118% gain on UAL in 105 days. Same month, different trader, same rules, account blown. The system that transformed 23 ordinary people into millionaires in the 1980s still works perfectly today. The S&P 500 breakout at 600 that looked weak ran to 650. NVDA's obvious failure at 400 shot to 1,000. The system works, but the humans using it don't. See, when Dennis recruited his turtles, he discovered something profound. Success in trading isn't about finding the perfect strategy. It's about becoming the person who can execute it. And after analyzing thousands of failed turtle traders, I've identified exactly 15 psychological mistakes that turn a profitable system into a wealth destroyer. These aren't complex technical errors. They're simple human behaviors that feel right but lead straight to ruin. Like taking profits too early, removing stop losses, or the most insidious one, following 80% of the rules and expecting 100% of results. Tonight, I'm exposing every single mistake. Not just what they are, but why your brain is hardwired to fall for them, and exactly how to rewire yourself to trade like the 5% who actually make money. Welcome to Trading Psychology Stick, where we don't just teach you what to do, we transform you into the trader who can actually do it. Quick note, this is educational content based on market psychology research, not personalized financial advice. Your results depend on your execution, but here's my promise. By the end of this video, you'll understand exactly why you've been sabotaging profitable trades. More importantly, you'll have a clear blueprint to stop the self-destruction and start trading with the discipline of a true turtle. Fair warning, what you're about to learn might make you angry. Angry at yourself for the money you've left on the table. But that anger, channel it into discipline, because starting tomorrow, you'll never make these mistakes again. Mistake number 1, the genius complex. You think you're smarter than a 40-year proven system. Picture this scenario. You discover the turtle rules. Buy 20-day breakouts. Exit on 10-day lows. Use ATR for stops. Your immediate reaction? That's it? My grandmother could do this. Let me add some indicators to filter out the bad trades. Congratulations, you just signed your account's death warrant. The data is brutal. Backtests show the original turtle strategy underperformed over the last 20 years. Know what performed even worse? Every single optimized version traders created. Adding RSI filters, volume confirmations, Fibonacci levels, all consistently underperformed the original. Case in point, August 2024. A trader using the original unmodified rules captured 118% on UAL in 105 days. Meanwhile, forums overflow with improved versions that can't break even. Michael Gibbons, successful trend follower, shares this gem. I stopped looking at news in 1978. A friend worked for the largest commodity news service. His major story was about sugar. When I asked how he knew all this, he said, I made it up. That's your sophisticated edge. Fiction. Richard Dennis tested this relentlessly. Rules made money, human judgment lost money, not sometimes. Always. He said, the better part of the whole thing was rules. The things that didn't work were judgments. Reality check. Your need to modify stems from ego, not logic. Following someone else's simple rules doesn't make you feel special. This intellectual vanity has destroyed more accounts than all market crashes combined. Tomorrow's assignment, write the original rules on paper. No modifications, no improvements, just the original rules. That's your new trading constitution. Mistake number 2, the crystal ball delusion. You predict instead of react. Every missed breakout has the same story. It doesn't look right. Volume's too low. RSI is overbought. Translation. You're cosplaying as a fortune teller, and fortune tellers don't drive Lamborghinis. They drive Toyotas. Use Toyotas. Cold hard math. Research shows 50 to 67% of breakouts fail immediately. Your gut feeling would be right 2/3 of the time. So, why take every signal? Because the 33% that work generate returns 4 to 5 times larger than the losses. You can be wrong twice as often as you're right and still print money, but only if you take every setup. The SPY 600 breakout in 2025 tells the whole story. Twitter analysts called it weak, low volume, overbought, terrible breadth, classic fake breakout signals. It ran to 650 without looking back. Truth bomb? Nobody can predict which breakout succeeds. Not you, not Goldman Sachs, not the Fed. The turtle system embraces this reality. It admits, I don't know which trade will work, so I'll take them all with proper risk management. Dennis was crystal clear. Look at prices rather than relying on information from television or newspaper commentators. He knew predictions were worthless theater. Price was the only truth. The psychology is simple. Skipping trades protects your ego from being wrong. Your mind creates elaborate justifications for why this setup doesn't look right. But the market doesn't care about your feelings or your analysis. Jesse Livermore died broke. Why? He switched from reacting to predicting. George Soros made billions following price, never forecasting it. Starting today, take every valid signal, let probability work. Stop trying to outsmart randomness. Mistake. Number 3, the action addiction. You equate movement with progress. Quick audit. How many trades did you place last week? If it's over 3, type overtrade in the comments. No judgment. Awareness is the first step. Jerry Parker places 10 to 15 trades per year. Per year. The average losing trader? That many per week. The difference isn't skill. It's understanding that trading isn't a video game where more action equals more points. Your brain treats trading like a slot machine. Every click releases dopamine. Every filled order feeds the addiction. You're not trading for profits anymore. You're trading for the high of trading. Parker's been running Chesapeake Capital since 1988. 3 decades of consistent profits. His edge? Diversification and taking small losses. That's really the secret for surviving. Notice what's missing. No mention of finding more trades. The uncomfortable math. Markets trend 20% of the time. That means 80% of the time. The correct trade is no trade. But try explaining that to a brain raised on TikTok and instant gratification. Let's do the damage calculation. Trade 200 times versus Parker's 15. You pay 13x more in commissions. Face 13x more slippage. Make 13x more emotional decisions. Expose yourself to 13x more random noise. Your profits? Not 13x, usually negative. Those extra 185 trades aren't opportunities. They're boredom manifesting as analysis. Revenge trades dressed up as setups. FOMO, wearing a technical indicator costume. One former turtle confessed. For most of us, it was just pleasing Rich. They wanted to show they were working, analyzing, grinding. But Dennis didn't want activity. He wanted discipline. New mantra. The best trade is often no trade. Success means doing less, not more. Mistake number 4, the premature profit panic. You grab 1R profits in a 10R world. Watch this mental movie. AAPL breaks out at 180. You buy. 3 days later, you're up $500 on a 10,000 position. Your brain starts its fear campaign. That's a car payment. Lock it in. What if it reverses? So, you sell at 182. Pat yourself on the back. AAPL continues to 190, then 200, then 210. You left 3,000 on the table to protect 500. You saved a car payment, but lost a vacation. The original turtles were trained to watch 20%, 50%, even 100% of open profits evaporate. Most traders would rather eat glass. That's precisely why most traders stay broke. The math doesn't lie. Average turtle winner ran 4 to 5 times larger than average loser. Not because they were lucky, because they let winners run while you're taking profits at 1R like it's Black Friday. Richard Dennis hammered this home. Don't focus on being right. Focus on making money when you are right. Being right isn't the goal. Being massively profitable when you're right is. Let me paint the painful picture. If your average loss is $1,000 and you always take profits at 1,000, you need a 50% win rate just to break even after costs. But let winners run to 4,000. You can be wrong 70% of the time and still profit. The psychology is predictable. You're so traumatized by previous losses, so terrified of giving back gains, that you sabotage the very trades that could pay for all your mistakes. Next time you're in profit, ask yourself, am I exiting because the trend ended or because I'm scared? Fear is not a trading signal. Mistake number 5, the stop-loss allergy. You remove stops thinking you're giving trades room. Nick Leeson had a theory. Stop losses were for amateurs. Professionals managed risk with experience and judgment. His professional approach vaporized Barings Bank, a 233-year-old institution, in weeks. The story always starts the same. If I just give it more room, it'll come back. These famous last words have blown more accounts than all black swans combined. Turtle Rules demanded something radical. Set your stop loss before entry, not after. Not adjusted based on price action. Before. One turtle got fired for violating this. No excuses, no exceptions. The stops used ATR, average true range. Volatile markets got wider stops. Quiet markets got tighter stops. Pure math, zero emotion, no negotiation. Plot twist. Curtis Faith, the superstar who banked $31.5 million more than any other turtle, seemed untouchable. By 2022, that same superstar was arrested as a homeless man in a Boston shelter, from millions to homeless. How? Simple. He stopped honoring his stops. The psychology is seductive. Moving a stop feels like flexibility, but it's actually weakness. You're choosing temporary comfort over permanent survival. You're betting hope against mathematics. Professional traders know the truth. The stop loss is your business partner. It's the bouncer keeping you out of trades that could end your career. It's the insurance policy that guarantees you'll still be trading next year. Leeson's bank survived Napoleon, 2 world wars, the Great Depression. One trader without stops killed it in 3 weeks. Before your next trade, write your stop on a Post-it. Stick it on your monitor. That number is sacred. Move it tighter? Fine. Move it wider? Never. Quick pause. We've covered 5 critical mistakes. The genius complex, crystal ball predictions, action addiction, premature profit panic, and stop-loss allergy. Notice the pattern? Each mistake feels smart, but leads to ruin. Take a breath. This is heavy material, but you're still here. That already separates you from the quitters. Fun fact, a turtle shell isn't for hiding. It's for protection while moving forward. That's your new trading philosophy. Ready for the next level? Let's go. Mistake number 6, the drawdown denial. You can't accept that winning systems have losing periods. December 2023 was brutal for trend followers, down 15% across the board. Forums filled with obituaries. Trend following is dead. Markets have evolved. The edge is gone. The quitters locked in losses and switched to mean reversion strategies. January 2025 arrived. China announced stimulus. Every market exploded in trends. Commodities, currencies, indices, all printing money. The patient traders who endured December's pain captured 40% gains. The quitters, still waiting for better conditions. Expecting a profitable system without drawdowns is like expecting a relationship without arguments. Good luck with that fantasy. The probability lesson most refuse to learn. A system with 40% wins and 2.5 to 1 reward risk will have losing streaks of 10+ trades, drawdowns of 20 to 30%. This isn't failure. It's statistics. Jerry Parker navigates this brilliantly. He admits, markets since 2008 have been the most challenging, yet he's still profitable after 3 decades. Why? He understands drawdowns aren't bugs, they're features. Consider Richard Dennis, the legend who spun 1,600 into 200 million, lost over half his wealth from 1987 to 1988. System broken? No. Markets shifted from trending to choppy. Same system that printed fortunes in trends lost money in ranges. The critical insight, Dennis expected this. He prepared his turtles for it. Markets cycle between trending and ranging. No system captures both. You make fortunes in your season and survive the off-season. If systems made money monthly, everyone would use them. The edge would vanish. Efficiency would kill profits. Drawdowns shake out weak hands, preserving opportunities for the disciplined. George Soros pulled $2 million from Dennis after 2 bad months. Dennis made $80 million in 1986. Soros built his billions elsewhere, but imagine if he'd stayed. Drawdowns are tuition. Pay them to stay enrolled in the game. Mistake number 7, the leverage lunacy. You think 10x leverage equals 10x profits. Time for honesty. What's your risk per trade? Don't know instantly? Calculate it now. Over 2%? You're juggling chainsaws. Drop your number in comments. Let's keep each other alive. The math should terrify you. At 1% risk per trade, expect 32% annual returns with 41% maximum drawdown. Bump risk to 5%. Returns jump to 76%, but drawdown explodes to 97%. Let that sink in. 97% drawdown means your 100,000 account becomes 3,000. To break even requires 3,233% returns. That's not trading, that's assisted financial suicide. The turtle rules were explicit. Never exceed 2% risk per trade. Not a suggestion, a survival requirement. Mathematics doesn't care about your impatience. Traders tell themselves beautiful lies. They're different. They'll stop before maximum drawdown. They'll adjust when things go badly. No, they won't. The death spiral looks like this. Trade 5% risk. Hit a normal 5-trade losing streak, down 25%. Panic sets in. Must make it back. Increase to 7% risk. Another loss. Down 32%. Now you're desperate. Risk 10% for the comeback. Account death in 3, 2, 1. The turtles used volatility-based position sizing. ATR determined how much markets moved. Position size adjusted so daily movement equaled consistent risk across all markets. More volatility meant smaller positions. Less volatility meant larger positions. Always respecting that 2% ceiling. Professional wisdom. There are old traders and bold traders, but no old bold traders. The bold ones betting 10% per trade, they're not trading anymore. The old ones grinding 1 to 2%, still collecting checks. New rule, risk small, win big. Slow money is still money. Fast money is usually no money. Mistake number 8, the pyramid phobia. You fear adding to winners, but love averaging losers. The amateur playbook. Stock drops. Buy more to lower your average. Stock rises. Take profits to lock in gains. Congratulations, you've got it perfectly backwards. The turtle edge wasn't the entry. It was pyramiding up to 4 units into winners. Let me show you why this matters. MSTR breaks out at 400. Unit 1, 25 shares. At 420, add Unit 2. At 460, Unit 3. At 500, Unit 4. Total position, 100 shares, average price, $45. MSTR runs to 600. The turtle exits with $15,500 profit. The typical trader who bought once at 400 and locked in at 480 made 2,000. Same trade, same direction. Nearly 8x difference in profit. The principle is elegant. Add to winners because they're proving themselves right. Every new high validates your thesis. By Unit 4, you have maximum exposure to your best performer. Meanwhile, averaging down is doubling down on being wrong. It's throwing good money after bad. It's hope masquerading as strategy. Dennis taught the distinction. The market pays you to be right, not to prove you were right. Adding to winners multiplies correct decisions. Adding to losers multiplies mistakes. Jerry Parker reveals why this is so hard. For most turtles, it was just pleasing Rich. They pyramided because Dennis demanded it, not because it felt natural. Left alone, most would have taken quick profits. The psychological barrier. When MSTR hits 460 and you're up 500, every instinct screams, protect these gains. The professional says add more exposure to this proven trend. Your winners deserve more capital, not less. Your losers deserve the exit, not rescue attempts. Mistake number 9, the hot tip hunter. You abandon system for inside information. Your brother-in-law texts, "My friend at Goldman says tech is going higher." By the time you get this inside information, you're not early to the party. You're the dessert course at Smart Money's exit feast. The turtles used zero fundamental analysis, zero news, zero tips, just price action. They banked $175 million while CNBC addicts went broke. Michael Gibbons drops this truth bomb. I stopped reading news in 1978. A friend was the top reporter at a major commodity service. His big story was about sugar's future. When I asked how he knew, he said, "I made it up." Made it up. That's your edge. Fiction sold as fact. The turtles proved something revolutionary. You don't need inside information. You need inside discipline. They knew nothing about heating oil fundamentals, soybean crop reports, or Fed thinking. They knew one thing: is price breaking out? Richard Dennis was fanatical about this. Look at prices rather than relying on information from television or newspaper commentators. This wasn't advice, it was law. The information paradox. If it's truly valuable, you won't hear it. If you're hearing it, it's worthless. The market already digested every fact, rumor, and whisper. It's all in the price. Every time you chase a tip, you're saying your tested edge isn't as good as someone's random story. You're trading statistical probability for narrative gambling. The market is the ultimate information processor. By the time you hear anything, 1,000,000 algorithms and 1,000 institutions already traded it. The only insider information that matters is already on your chart. Mistake number 10, the optimization obsession. You backtest perfect parameters for past data. Optimization is educational fraud. You're teaching your system to cheat on a test that will never be given again. The evidence is damning. Backtests show turtle rules underperformed from 1996 to 2009. Traders see this and start tweaking. Test 17-day entries, 23-day entries, different stops. Eventually, they find gold. 23-day entry with 13-day exit beats the original by 40%. They go live with confidence. Reality delivers a beating. The optimized parameters only worked because they randomly fit historical quirks. When patterns shift, and they always shift, the system implodes. Meanwhile, traders who grasp the concept, rather than the parameters, keep profiting. They didn't change 20 to 23 days. They understood trend following works and adapted the philosophy to modern markets. Dennis chose round numbers deliberately. 20-day breakout, 10-day exit. Not because they were optimal, because they were robust. They worked adequately everywhere, not perfectly anywhere. The 20-day parameter captures a human constant, roughly 1 month of trading, long enough to filter noise, short enough to catch trends. It worked in the 1980s, works today, will work in 2030. Professional system developers test for robustness, not perfection. They want strategies that survive all conditions, not dominate past conditions. Good enough consistently beats perfect temporarily. Every parameter tweak is another nail in your strategy's coffin. You're not finding edge, you're finding noise. And noise never repeats. The best parameter, the one that works adequately everywhere. You're crushing this. 2/3 complete. Most viewers would have quit by now, but you're different. You're proving you have what it takes. Real turtles can live over 100 years. Not because they're fast, but because they're consistent. Your trading longevity depends on the same principle. Ready for the final 5? These are the career killers. Mistake number 11, the market timer's curse. You try to turn off the system during bad markets. George Soros, brilliant as he was, pulled $2 million from Dennis after 2 bad months. Dennis proceeded to make $80 million in 1986. The lesson? Even geniuses can't time when systems will work. Missing the best 10 days per decade cuts returns by 50%. Guess when those days occur? Right after the worst ones. Your attempts to avoid pain guarantee you'll miss gains. December 2023 tortured trend followers, down 15% minimum. The chorus was deafening. Trend following is dead. Markets have changed. Too many algos. Those who went to cash missed January 2025's explosion. China stimulus ignited trends everywhere. Patient traders who endured December's punishment captured 40% gains. The timers? Still waiting for clear signals. Jerry Parker survived 3 decades using one approach. Through dot-com bubbles, through 2008, through COVID, his secret isn't timing, it's showing up. Parker's philosophy, diversification and taking small losses. That's really the secret. Notice what's absent. Any mention of predicting good or bad markets. The timing paradox. Systems work best after they've struggled. They struggle after working great. Human nature does the opposite, piling in after profits, bailing after losses. Picture this. After 18 months of drawdowns, every cell screams, "This isn't working." Your spouse questions your sanity. Friends mock your stubbornness. Evidence seems overwhelming. That's precisely when discipline matters most. The greatest fortunes weren't made timing markets. They were made surviving them. Buffett doesn't time. Renaissance doesn't time. They show up daily because time in the market beats timing the market. Your job isn't predicting when the system works. It's being there when it does. Mistake number 12, the selective memory syndrome. You remember wins vividly, forget losses existed. Challenge time, journal your next 10 trades, just 10. Entry reason, exit reason, result. Return in 2 weeks and share what patterns you discovered. Type journal if you're in. Memory is marketing. Your brain runs a propaganda campaign where you're always the hero and losses were flukes. William Equate taught this critical concept. You shouldn't care about how you got to the current state, but rather about what you should do now. But without records, you can't see the current state clearly. The turtle win rate was 38 to 40%, less than a coin flip, yet it printed millions. How many traders would stick with that reality without documenting the massive winners offsetting frequent losers? Your brain's creative accounting. That TSLA trade where you made 3,000, vivid, crystal clear. The 5 attempts before losing 600 each, fuzzy, somehow forgotten. Net result, 0, your memory, crushed TSLA. This isn't conscious deception, it's unconscious protection. Your ego can't handle the truth that trading is hard. You're usually wrong, and success comes from grinding mathematical edge over hundreds of trades. The turtles documented everything: entry reason, exit reason, emotional state, market condition, not for Dennis, for themselves, to combat the fiction their brains would otherwise create. Without a journal, you're flying blind, navigating by feelings instead of facts. Your feelings about your trading are always wrong. Always. Only data tells truth. Only records reveal patterns. Only documentation drives improvement. Mistake number 13. The halfway hero. You follow 80% of the rules and expect 100% of results. Dennis nailed it. Almost anybody can make up a list of rules that are 80% as good as what we taught. What they couldn't do is give them the confidence to stick to those rules when things are going bad. Trading systems are like flight checklists. Skip 20% of pre-flight checks and your plane might fly, or it might crash. They want to find out at 30,000 feet? The shocking truth: multiple turtles failed despite having identical rules. Same teacher, same capital, same system. Completely different outcomes. Why? They followed most rules most of the time. They'd use 23-day breakouts instead of 20, close enough. Risk 3% on high conviction trades, just this once. Exit early when the trend felt exhausted. Skip signals after losses to be selective. Each modification seemed minor, reasonable, even smart. Combined, they transformed a profitable system into expensive gambling. Forum posts reveal this constantly. I use turtle rules, but with 23-day breakouts. That's not turtle trading. That's a completely different untested system wearing a turtle costume. Every rule exists for a reason. The 20-day breakout? Validated across decades. The 2% risk? Optimized for survival. The pyramid rules? Maximizes trend capture. Your improvements are untested hunches fighting proven mathematics. Partial compliance creates unknown risk. You can't debug a system you're not following. You can't trust results from bent rules. You can't achieve someone else's success with your interpretations. Excellence means doing ordinary things with extraordinary discipline. Mistake number 14. The system hopper's doom. You collect strategies like Pokemon cards. The pattern is everywhere. Try turtle trading, hit drawdown. This worked in the 80s, but markets changed. Switch to mean reversion. Works until trends develop, account shredded, markets two-directional now. Try Elliott wave, then supply and demand. Then ICT, then SMC. 2 years pass. 6 systems attempted. 0 profits earned. The tragedy? Every abandoned system had profitable periods after you quit. You experienced each system's pain, but none of their gain. Jerry Parker's used essentially the same approach since 1988. Through every market condition, through every death of trend-following article, still profitable, still trading. His edge isn't the perfect system. It's the perfect commitment to one system through all its seasons. System hopping is like changing grocery store lines. The moment you switch, your old line speeds up. You're perpetually in the wrong place at the wrong time, not from bad luck, from bad discipline. Success comes from dancing with one partner through the entire song, not switching every time you step on their toes. Every system has rough patches. Profits come from surviving them, not avoiding them. Parker dances with trend following, Buffett with value investing, Renaissance with mathematical patterns. All have rough periods. All survive them. All prosper long term. The next system isn't better, just different. Mastery comes from depth, not breadth. Mistake number 15, the knowing-doing gap. You know everything but execute nothing. This is the final boss, the ultimate destroyer, and it has a name, Curtis Faith. Faith made $31.5 million as a turtle, most successful by far, youngest by far. He literally wrote the book on turtle trading. Every rule explained, every secret revealed. By 2007, his fund lost 70%. The CFTC banned him from trading. By 2022, the Wall Street Journal's Golden Boy was arrested as a homeless man in Boston, from $31.5 million to homeless. What happened? Simple. He stopped following his own rules. Faith started. Acceleration Capital convinced he could improve Dennis's teachings, added complexity, adjusted based on experience, took bigger risks because he was Curtis Faith, the superstar. The market didn't care about his reputation. It destroyed him. This terrifies me more than any crash, because it proves knowing everything provides zero protection without discipline. Education without execution equals expensive entertainment. Every trader faces this gap. You've read the books, watched the videos, understand the concepts. You know exactly what to do. Then real money meets real markets and your knowledge evaporates. The market doesn't care what you know, only what you do. The hardest part isn't learning the rules. It's following them when following them hurts. Your education is complete. Now only execution matters. There are no more lessons, only actions. Choose your worst mistake from these 15. For your next 10 trades, focus on fixing only that mistake. Master one before moving to another. You've just discovered the 15 psychological mistakes that turn profitable systems into account destroyers. From the genius complex that makes you overcomplicate simplicity, to the knowing-doing gap that destroyed Curtis Faith after he made $31.5 million. Each mistake is a mirror, showing exactly why discipline beats intelligence in markets. Remember, the system that made $175 million still works. That UAL trade in 2024 proved it, 118% in 105 days. The only variable is you. Which mistake has been killing your discipline? Drop the number in the comments. I read every single one, and the honesty in this community continues to blow me away. Want to stop sabotaging yourself? I've created the Ultimate Turtle Trader's psychological checklist, all 15 mistakes with daily exercises to build discipline, plus the exact original rules Dennis taught, word for word, free download in the description. Next week's video, Jerry Parker opens his actual positions at Chesapeake Capital. See exactly how the most successful living turtle still trades after 37 years. Real positions, real explanations, hit subscribe and the bell. Remember this, Richard Dennis said, I could publish my trading rules in the newspaper and no one would follow them. Prove him wrong or prove him right. The choice is yours. Trade with discipline, stay humble, and I'll see you in the next one.